Everyone. Thank you for joining us today for this edition of the RefCom webinar series. My name is Becky Peterson, and I am the Program Manager for RefCom Events. I'm excited to introduce my colleague from CREW, Dr. Peter Harrison. Dr. Harrison has worked on CREW sulfur and sulfuric acid analysis since joining the company in early 2011 and is the head of the sulfur team. He also works across other nutrient areas, including both market and cost analysis. Prior to joining CREW, Dr. Harrison completed a PhD in industrial chemistry at Durham University. With that, I'll ask Peter to take over. Peter?
Thank you very much for the introduction. I'm also very happy to be here and present to the RefCom community, and I think the link is undeniable that sulfur has an awful lot to do with refining and general oil and gas production. And some of the points I'm going to touch on as part of the presentation today are really highlighting that kind of link and the progress or the process of getting from the market that exists today to a different market scenario that will exist in the future. So the title, again, the presentation today is formed of is, again, how will the long-term sulfur market be impacted by decarbonization? And again, the topic of decarbonization is hugely broad, and the outcomes and the direction that decarbonization will take is hugely contentious as well. However, what I'm going to try and do today is present a spectrum of possibilities that enable, even in a topic of such breadth, for some conclusions and some scenarios to be drawn that will determine if the sulfur market remains in a balanced state as it has been for the last 30, 40 years, or if there are some more structural issues that might start to emerge. So again, this is just a very brief legal notice, but moving on from that to something hopefully slightly more exciting. So I'm going to start just by reviewing a little bit of what the history of the sulfur markets looked like for the last 30 years, how that market evolved, what some of the structural factors that determine the prior market, but also the current day markets. Again, some of the impacts that decarbonization could have, some of the potential scenarios that decarbonization could manifest in, and the effect that that will have on both supply and demand. And then finally, looking at the kind of topic of longer term sulfur availability, what some of the risks, can they be managed, are alternatives required, and trying to bring together some of the potential outcomes that might be necessary in a market 30 years from now. One thing I was just going to say, so at any point the Q&A system is open, so if anybody has any questions as they go along, please feel free to enter them into the Q&A box. And we will come back to them at the end. Again, similarly, if you want to wait until the end and answer those questions and during the Q&A session, then please feel free to also. So moving on, as I said, to the historical perspective, and again, this looking back to the 1990s, if you go back further than this, is really a continuation of the status of the market that existed in 1990. And essentially, the key point in the 90s through to the 2000s was that sulfur was predominantly byproduct supply, but still significantly influenced by intentional production. So the other production here in 1990 is predominantly fresh mining, particularly in the US Gulf, but also other parts of the world. If you go back into the 80s and the 70s, the gap gets bigger. Again, really from the 70s onwards is where demand really started to pick up. Again, the dawn of the sulfur industry really in Canada from gas-based sulfur supply saw a huge amount of stock build, and then demand really started to kick in from the kind of 70s and 80s onwards. Obviously, if you go through to 2000, the last US Gulf sulfur mine closed in 2000, and that saw a market at that point which was more than 90% byproduct supply, predominantly gas, with a large contribution coming from oil. Throughout the 2000s to 2010, you see that balance kind of re-equilibrate a little bit. Lots of growth in oil-based supply, principally driven by improvements in fuel quality, but also increased efforts of desulfurizing more of the product mix. So not just reductions in the amount of the ppm content of sulfur in diesel and gasoline, but also extracting greater sulfur content from everything to allow for further treating and further processing into arguably some more useful and interesting product groups, as opposed to the simple refineries that existed in history. And the other thing across this time frame was the increase in use of sourer, higher sulfur content crudes as well. So again, by 2010, you're looking at a market that's approximately 50-50 oil-based sulfur to gas-based sulfur, with a very tiny contribution from other and mined supply. Looking forward to last year, and you can see again that situation has broadly stayed the same. You've got roughly 50-50 supply mix between oil and gas. Again, there's been some significant growth in gas-based sulfur from some very high sulfur content wells, but at the same time, you've had very high sulfur content crudes going into some of the new refining capacity, particularly in the Middle East and China, that has allowed that oil-based sulfur supply to keep pace. So again, I think post 2000, the sulfur market in terms of structure from feedstocks has looked roughly similar, but the key thing is that it's very different from the sulfur market that existed 10 years prior to that. Looking a little bit at where those changes have happened, and there's, I suppose, an even more kind of interesting or complex story that comes from that. Again, North America has been the historical kind of home of or the advent of sulfur industry in the kind of modern refining age. You can see back in 1990, North America was 15 out of 38 million tons of supply. Going forward, that number peaked in the late 90s and into 2000s and has been in decline ever since. And predominantly that decline has been due to declines in gas-based sulfur supply in Canada, but more recently declines in refinery-based sulfur supply in the US as well. If you look at the opposing trend for the Middle East, again, that is the opposite of both of those trends: increased refinery capacity, but also increased sulfur content in gas extraction as well. The CIS, so here captured Russia, Kazakhstan, Turkmenistan, and other former Soviet Union countries in and around Central Asia. Again, you can see 1990s, 2000s, early 2010s, a significant contribution coming from historical gas-based sulfur assets, particularly in Russia, but also in Kazakhstan. The growth since then has been more Turkmenistan and further expansions in Kazakhstan. And then China as the other kind of, I suppose, more dramatic story in terms of change. You can see that in 2000, even through to 2005, 6, 7, 8, 9, China was essentially not producing sulfur at all. Look forward to today, China as an individual country is the largest single producer of sulfur in the world. So you have this transition that's been very dramatic, is much more diversified in terms of contribution, in terms of corporate level, but it's predominantly come from refinery-based sulfur. But you're looking at roughly 20-30% of supply coming from gas-based sulfur as well. So again, these four markets capture, as shown here, approximately 75-80% of global supply. Absolutely, North America is still hugely significant as a supply source, but the growth has really been focused in the Middle East, CIS, and China. And that's a story that we see continuing as well, that you have this transition of established Western developed markets yielding back a little bit of the hydrocarbon volume that they've been producing, and that moving partly to Asia and to other parts of the world, but also at a point starting to decline on a global basis as well. But I think another key thing, which I'll come on to in a moment, is the structure of where decarbonization will happen is not universal. The rate of decarbonization in India, in Indonesia, in China is not going to be the same as it is in Europe or the US or other parts of the world. There will be differences that happen there. And again, going back to the point I made on the slide before, if you look at a market like North America, particularly the US is 90% plus refinery-based sulfur. And actually, some of the biggest changes on a global basis in terms of cuts in sulfur supply because of decarbonization efforts will come from refinery-based sulfur and will come in the US from refinery-based sulfur. So the impact that could happen in a regional basis is much more dramatic than maybe the global number might depict, because of changes in where in the world some of this supply will come from. So looking a little bit now at the demand side, and again, that progression from a 40 million ton market to what is close to a 60 million ton market today, has again been predominated by growth in phosphates and fertilizer production, but also significant step up in industrial demand. So you can see the phosphate industry is 10 million tons larger. The industrial markets that exist around the world are close to 8 million tons larger. But also in the metal sector, you're looking at a market which was less than 500,000 tons of demand, is now close to 5 million tons of demand, and other fertilizer production, so from things like ammonium sulfate, some of the other kind of more chemical industry driven fertilizer production has added a couple of million tons. So you can see this structure of the market still over 50% coming from the fertilizer sector. Metals are more significant and industrial markets are more significant than they historically were. If you look at, again, the structure of, geographically, the structure of that supply, the same is true that I just mentioned for supply. You've had this transition from established Western markets towards Asian markets. And the change in Chinese sulfur consumption started earlier. So if you think back to that slide I was just showing on supply, China really had no production until 2010. It had consumption throughout all of the early 2000s and into 2010. But since then has been really pulling back in terms of the volume of import requirement and the amount of reliance on the international market, and kind of backwardly integrating into its own production and increasing its self-sufficiency in terms of sulfur. So again, the structure of the consumption has changed, but as predominantly a similar dominance of one industry. The structure of consumption is much different today than it has been historically as well. So looking at all that together, and you're looking at, again, for the sulfur industry, a market where there is no required link between supply and demand, and you could think, well, surely there are surpluses and deficits all over the place and that the market is totally dysfunctional. In actual fact, yes, there have been periods of time of significant surplus, of significant deficit, as you can see across this time frame. However, broadly, you've been within 5 to 8% of the total market size as a surplus or deficit, and actually post 2010 much less than that. You're looking at kind of 2 or 3% surplus or deficit throughout that time frame. Yes, in a market that's 60 million tons, 2 or 3% is above 1 million tons of surplus or deficit, so you need to find something to do with that and somewhere to put that. But it is not a market that's chronically long or short of supply, or has not been a market chronically long or short of supply. And I think that is a very comfortable situation that the sulfur market has been in. And actually, the close to 13 years that I've been looking at this market, the question of when will there be a flood of supply and there'll be far too much sulfur, it's interesting now that that question has almost flipped entirely on its head, that now the frequency of when will we run out is becoming much more pressing. And again, I think part of that is around the inherent volatility of the market, but also of how one thinks about the market on the sulfur side. But I think it's a much more real risk into the future that sulfur fails to keep pace with demand as it has throughout history. And again, I said there's no real link between supply and demand. Obviously, there is an economic growth link, that GDP growth influences refining, and in the same way it also influences industrial activity, which influences consumption. But these two things are not balancing each other out. There is not a producer of sulfur who's making more to meet demand or making less when demand falters. So again, that inherent disconnect is always going to be there. It was not there in the 1990s is the key thing. When surpluses and deficits existed then, you had intentional production cutting back to mitigate the risk of actual damaging oversupply and physical surpluses affecting the ability to place supply in the market. So looking forward a little bit now, I hope that gave an overview of how things have been. As I mentioned, with a market that is now 98% byproduct supply from hydrocarbon processing, decarbonization, you would think, could have a significant impact of that. A reduction in oil consumption, a reduction in gas processing. You would naturally think, well, if you lose input, you lose output. And that is true. And I'll look at some scenarios about what that could look like. But it's not quite as simple as that. And I hope I'll try and pull out some of the more nuanced impacts that can happen as you look across how sulfur production can vary with oil and gas input. So Just to start with, though, I think looking at whether the market will be balanced or not requires a demand story as well. And I think our projections for demand, this is now going out to 2050, sees a significant increase in metals-based demand, principally in the nickel industry, but also in things like uranium, lithium extraction, manganese extraction, lots of other industries, and some of that actually also being captured in that industrial market growth where, again, you're not looking at direct metal extraction, but kind of further upgrading and processing. We see growth there, again, principally driven to facilitate the additions of battery capacity and growth in electric vehicle demand, which is happening in many parts of the world, but at different rates and at different kind of levels of increase. But also we're expecting to see a continued growth rate in the phosphate industry. Again, phosphates have had a difficult few years and have seen a relatively stagnant and flat market throughout the 2015 to 2023 kind of time frame. However, the fundamental basis of more people need more food, which needs more crops, which needs more fertilizers, remains pretty true. And again, a world of 8 or 9 billion people is not going to exist without fertilizer application. So again, we have a relatively strong view of demand growth there as well. So if you go from 2023 levels of about 67 million tons of sulfur consumption in 27 years from now, which is admittedly a very long time, we're looking at closer to 96, 97 million tons of 98 million tons. I can't read my own slide. I even wrote it there so I'd remember. 98 million tons of consumption at that time frame. So you're looking at about 30 million tons of increase, so just under 50% growth across that 27-year time frame, which actually on a year-on-year basis is not inconsistent with the growth rate that we've seen over recent years. So moving on now, as I mentioned, we've defined that view of demand. Demand growth is likely to be relatively strong. That demand growth trend is likely to be well supported by population growth, but also changes in the behaviors of the population of the world. We're now going to look a little bit at some of the decarbonization stories that exist. So the high, low, and base cases here are based off some of the work that teams like the IEA prepare and the various climate scenarios that they have projected out to this kind of 2050 timeframe, and essentially consist of very little changing for the next 20 years and then decarbonization kicking in the 2040s, a consistent decline in oil demand post 2030 down to a level of around 70 million barrels per day in 2050, and a much more dramatic rate of decline which would get to levels of below 60 million barrels per day by 2050 in that low case. And the point of this presentation is not to define which of these is correct. And I think maybe none of these are correct. But looking at that spectrum of possibilities, it's important to think, well, if nothing changes, what will the world look like? If everything changes, also, what will the world look like in terms of sulfur availability? On the gas side, we have a slightly opposing view to that. And again, these are based off some of those climate scenarios that the IEA has prepared. And we see even our base case view actually having some growth potential through to the 2040s, principally by substitution out of coal and into gas for a lot of power generation, but also some in the shipping industry moving to LNG and out of some refined fuels. But then again, if you look at a high case, there are arguments and there are views that gas growth is much more significant and then merely plateaus in the 2040s and 2050s. The low case view here is a peak in and around 2030 and then a consistent decline in gas demand. But again, not a dramatic decline in gas demand through to 2050. Yes, these could be more significant, but certainly the view we have taken is the potential for decarbonization and cuts in feedstock input are higher in oil and coal, which are generally considered to be higher carbon contribution than gas. And the gas industry has got a longer lifetime to live in terms of consistent production and going out for the next few years. Again, the point here is not whether one is right, one is wrong. These are two or arguably 6 scenarios of how the world could look based on these changes. So looking at all of that, again, what would be in our base case view of 30% decline in sulfur, in oil processing for the oil industry, so the oil refining industry, or what is essentially a flat market in terms of gas. You could think from that, well, 30% decline in oil, surely that's a huge impact in terms of sulfur production. And I think It could be, but I think one of the mitigating factors that we certainly see, and that has been consistently the case throughout the last 30, 40 years, is if you look at the intensity of production of sulfur per unit of hydrocarbon. For oil, you can see here that essentially every single year post 1990, and actually this is only back to 1990 because we don't have consistent data before that, but if you looked back further than that, this would be true as well post throughout the 1980s and the 1970s, that the amount of sulfur produced per barrel of oil has been increasing every single year pretty much. There are lumps in there, but the trend is very much positive. Our base case view is that trend continues, and you get from what is essentially 0.4 million tons per million barrels of oil up to closer to 0.43 to 0.45, so approximately a 10% increase in sulfur content in crude. The low case essentially being much flatter than that. The high case, incidentally, the label's there for low and high the other way around, but I hope it's clear that the top one is the high case, the bottom one is the low case. A much lower. So again, it's possible that we just stagnate from now on in terms of that sulfur content and capture rate, or things increase dramatically from now. I think one thing that supports this, again, some of the work that I've seen from, again, oil industry bodies such as OPEC and a few others, has been the projected average sulfur content in crude globally anyway. So the kind of numbers that I've seen from there as an average going up from about 1.15 to 1.2% currently, close to 1.45 to 1.5% in the future, really a reflection of the kinds of crudes that will exist 30 years from now, have more sulfur content than the kind of crudes that exist today. Looking at the gas side, and the historical trend is much less clear. The recent trend is much more dramatic. And I think the projection that we have taken is that if you look at the types of projects which are being talked about and that are available for progression at the moment, they are generally very high sulfur content and actually relatively minor gas volume. So again, if you look at some of the projects in the Middle East, high sulfur, like ultra sour projects, you're looking at a BCM of gas yielding 3.5, 4.5, 5 million tons of sulfur. So incredible volumes of sulfur content. But again, thinking back to the gas industry, a relatively tiny contribution to gas demand. So I think those kind of projects can really start to boost the gas industry at a much higher rate than we've seen, certainly throughout the 2010s, where those kind of developments were pretty minimal. And again, that rate of increase is what we kind of see going forward as well. So with those two things being in mind, looking at what is next and what the implications for sulfur from those industry are not as simple as saying, well, less hydrocarbon is less sulfur. And initially, to start looking at that on the gas side, you can see that in all these industries, we're expecting to see a continued rate of increase going forward. Again, in the base case, a market where by 2028, which is the end of our current 5-year forecast, we have around 40 million tons of sulfur coming from gas, that increasing to close to 55, 60 million tons by 2050. So again, that plateauing of gas supply and the start decline that we had projected into the 2040s and 2050s, actually resulting in just flat output in that time frame. And obviously you can see there are higher and lower cases around that as well. But the key thing is, even in a low case where you have consistent decline in gas demand post 2030, you only have stable sulfur content. Sulfur output from that industry because of that higher rate of gas per unit higher rate of sulfur per unit of gas. The ordering of this is a little bit out, but again, essentially the third part includes the slide just beforehand. But then again, if you look at going back to the same comparison for the oil-based sulfur and the amount of sulfur coming out of refining, as I mentioned, if you look at that base case, going back to that oil forecast, about a 30% decline in sulfur, in finished crude going into refineries. This, even in the base case by 2050, is only around a 5 or 10% decline in sulfur output. And actually in the immediate near term, even with decline in that base case, post 2030, relatively stable output of sulfur from oil. Again, that high case, including even higher, sulfur capture rates and a continued increase in sulfur, in oil demand. You can see that approximately 5 to 8 million tons higher supply could happen. And again, even in that low case where you're looking at a further 10-15% reduction in the amount of crude consumption by 2050, you're still only back at 30 million tons from 40 million tons. So you're looking at 25% decline in sulfur output from refining versus more than a 40% decline in crude crude input. So those arguably kind of intensity of production or environmental effects of extracting sulfur are going to be really important to maintaining or preventing decline in some of this output, but also could change some of the potential for which types of crude become interesting or popular or necessary for refiners to process. And again, some of that might just be what is available, but some of that might be an intentional choice as well to capture some of the value that could come from processing sulfur as well. So if you put all that together, again, obviously supply intersects demand, and you can see obviously throughout history we've had an incredibly tight link between the two. Once you start to impact, again, the implications of decarbonization are predominantly going to be felt in terms of direct impact on the supply side, but at the same time you could see demand being boosted, and as I mentioned, for that metals industry, that's principally a kind of double hit to the sulfur market tightness, because increased use in batteries is decreased use of hydrocarbons, so you're losing supply, then you're also adding demand to make those metals that go into those products. Similarly, if you look at the agricultural industry, some of the trends that we've seen at the moment in North America are essentially involving using non-crude feedstocks to go into refining. And again, that is in theory or in practice boosting fertilizer consumption. So again, you're cutting crude consumption, therefore cutting sulfur input and sulfur output, but at the same time you're boosting demand for the products as well. So we have this situation where that structure of that market balance, I think, will change. Our base case view is that things are relatively balanced throughout the 2030s, and that again, out of the consistent level of fortune and progression along the same lines of GDP growth, there isn't very much that changes through to 2040. It's key that you have the increase in sulfur content or sulfur capture carry on throughout that time frame to get that to happen. But it's feasible that the market remains pretty balanced through to 2040. At the same time, that high case, which I think would be optimistic, if to continue to see some of the efforts that have already happened start to be reversed, could see a surplus throughout that time frame, and in that low case you would start to see much more meaningful deficits. The reality is the exact progression of each of these along these lines may not be how the world actually moves, but you could get a step change at some point. You could get a much more dramatic reversion to one of these trends at some point. And I think the key thing here is the likelihood or the potential for physical lack of supply relative to demand is much more likely today than it's been for the last 30 years. And that's worth considering what the alternatives are, what the possibilities are. If you're building a sulfur burner today for a project, the physical life of that asset is going to be 20, 30, 40 years. This is just looking at the next 27 years. So within that lifetime, in that base case view, you run out in the 2040s and you can't meet all demand. In the low case view, the world fails to meet demand even before 2030. And again, that would be very extreme for that to happen, but it's certainly a much bigger question than it's ever been before. So looking a little bit now at what some of the alternatives are. So again, sulfur is an industry that's had consistent surpluses throughout history. So there is sulfur sitting around in piles around the world that you could use to meet demand. And again, if you look at that base case view or a market that's just in deficit, yes, that what is currently above 20 million tons, so 25 million tons of sulfur stock around the world could manage the kind of typical imbalances that we see year on year in the sulfur market. But it's going to run out very quickly in a market of 2, 3, 4, 5 million ton deficits. And that's also assuming you can get it out. Because again, typically the location of those stocks they are where they are because they're in difficult places to access. And the logistics routes to get in and out are the trigger of that stock build historically. Another option is alternative acid routes. So again, if you can't get sulfur, can you get acid in another way? So more smelter acid, pyrites-based acid would avoid the need to go via sulfur. Sulfur has lots of benefits in terms of energy credit and ease of handling and concentration of sulfur content to move around the world. But for some areas, some of these other routes may well be perfectly viable. And actually, interestingly, a soon to commission project in Indonesia will be using byproduct pyrites from copper mining to produce acid directly for nickel leaching. So these are not kind of crazy routes into avoiding sulfur demand. They are things that are happening now, and I think the potential for more of that is maybe part of that demand story in the future that starts to thrift away a little bit of consumption for the areas that it makes sense. Another theoretical or potential route would be use of something like calcium sulfate, gypsum, which again at phosphate operations there are very significant stocks of. But even from a mineral extraction route, there is broadly limitless content of gypsum. And I think the issue here is that it is not just a theoretically possible route to decompose that gypsum back to a sulfur raw material that you can use to make acid, but it is energetically non-favorable. So you're in a situation where costs would be higher, energy costs would be greater. You would need a market that incentivized you to find a way of making that better, a way of making that work. But again, it's in terms of the kind of discussions that you see around the world around a circular economy and a kind of mutually beneficial process routes for consumers, something like the phosphate industry could arguably be near enough self-sufficient if they could use their own gypsum to get back to sulfuric acid feedstock and cycle that product round and round and round. Again, whether that is feasible on a power availability basis, on an energy cost basis, that's yet to be determined, but it is a theoretical possibility. Again, another route could be going back to the 1990s and pre-1990s and have direct sulfur extraction. I think this is somewhere that could very reasonably be a greater component of supply into the future. Again, the resource that was left in 2000 and the 1990s is predominantly exactly where it was left before. The economics of extraction in a market which is so dominated by byproduct supply are difficult, but in a market that's consistently in a kind of structural deficit, the economics could very quickly or reasonably swing to a point where fresh mining became the marginal producer and was incentivized back into the market. Again, I don't think that realistically is a possibility until at least the mid to late 2030s or 2040s, and would need consistent deficits to have materialized in the first place, would have needed stock drawdown to have been worked through, but I don't think it's an impossible outcome either. And then finally, I think something probably longer term and a requirement of that primary feedstock of gas or other high sulfur content hydrocarbons to have kind of been reduced is essentially, as I mentioned, for the gas industry, you have some very sour, high sulfur content gas wells that at the moment are not making very much gas and are making a lot of sulfur. The intention is still to extract that gas and consume that product. In a market where sulfur is structurally tight, where there isn't that availability, could you potentially see them no longer being considered high sulfur content gas wells, but they could, in theory, become gas-containing sulfur extraction points going into the future? And again, the cost structure would need to be dramatically different for that to make sense, and the price of sulfur would need to be dramatically higher for that to make sense, and the demand dynamic for gas would need to be very different. But in terms of which project is better to progress, what type of asset to go ahead with, this could start to become influential in terms of balancing out that potential sulfur deficit that could materialize post 2040. So there's a lot of questions. What the future is going to look like, how that actually looks 10 years from now, 20 years from now. I think the fundamental point that I would make is, I think the risk is higher, the certainty is not necessarily higher. So again, if you look at the first question of like, will sulfur supply fall short of demand? And I think in reality, you're looking at possibly. In the right scenario for demand and the wrong scenario for supply, that could materialize very soon. I think 10 years from now is not infeasible to see there being slightly more structural issues in supply meeting demand if we don't see some of that growth in sulfur extraction rate and we see a particularly strong decline in hydrocarbon use. but I don't think it's a certainty in even in this 30-year time horizon. It's not guaranteed. I think, will alternatives exist? Alternatives to the existing market structure be needed? And I think the answer is probably. Again, if you look at the rate of certainty that a project might have, will they choose something else to mitigate the risk of not having to use sulfur? We've already seen that happening. So I think the chances that the adoption of the progression of the smelting industry will see more smelter acid available, but the chances you see pyrite roasting return as a more international route into acid in the right places, I think is much more likely than it had been over recent history. But I think the kind of fundamental kind of question on the relevance of the sulfur industry, and again, will sulfur remain a crucial commodity to kind of maintain the function and structure of the modern world and how industry is going to operate? Is acid still a necessary feedstock, or can you just walk away and say, well, we've run out of sulfur, so we won't need to use any acid anymore? And I think the reality of that is no. I think, again, sulfur will almost definitely still be a required route into the kinds of chemical process and extraction methods that the world has become accustomed to, because the alternatives don't really exist on a kind of the scale that the sulfur industry has allowed them to. And as I said, even by 2040, the kind of base case view that we have is looking at deficits in the single-digit millions of tons, which is arguably still manageable with the existing stockpiles. I think post-2050, the availability of sulfur probably needs technological change and a much more dramatic focus on where it comes from and where it goes to. But I don't think not being involved in the industry of sulfur and sulfuric acid is a feasible possibility, certainly in the next 30-year time horizon, and arguably not in the next 50-year, 100-year time horizon. That sulfur and sulfuric acid are going to be very crucial to maintaining the world going forward. So that was the kind of the breadth of the topic I was going to touch on today. So we can move on to some of the Q&A session now. So there are a couple of questions which have come in already. So I will move through them, and then we can, if anybody has any more, then please feel free to keep adding. So have a question on, will onshoring of industry, will onshoring affect the industry dynamics? So whether that be, again, from my perspective, increased use of domestic hydrocarbon feedstocks or promotion of use of domestic hydrocarbon feedstocks, or from the demand side, a kind of reinvigorated focus on consuming or producing the battery raw materials, fertilizer products in home countries as opposed to relying so heavily on the international seaborne trade market. I think both of those two things are very relevant for the sulfur and acid market. I think particularly if you look at somewhere like North America, which again is predominantly focused on domestic raw materials, but could quite reasonably see an increase in some of the more prevalent sour crude feedstocks going into refining over time. And at the same time, if you look at the demand side of the industry, I think we're already starting to see this with some of the metals extraction and the kind of focus on critical minerals that you see, again, particularly in the battery space, where China is so heavily dominant on intermediates, so throughout the value chain, and so many of those are reliant on sulfur and sulfuric acid as an input into those processes. So both nickel sulfate, lithium, cobalt, manganese, all of those types of products are pretty crucial in meeting some of those future metals demand for those advanced end uses. And I think we're already starting to see that. We see that in North America, we see that in Europe, and the broad point is trying to mitigate or reduce the Western economy's reliance on China as a trade partner. And I think more recently we've already seen graphite as an example of this, not an industry that consumes sulfur or sulfuric acid, but an industry that China is currently imposing trade barriers on to the rest of the world, but is crucial to meeting some of the battery production aspirations that exist. So I don't think is this a risk that some of the Western nations' trade partners might start to be less helpful in terms of supplying them everything they need. I think it's already happening, so I think the trend is absolutely there. And I think the key thing is, if you're a nation with high sulfur content crude, you could potentially switch into that, boost some of that supply availability. But at the same time, the demand story is predominantly going to increase consumption as well. So moving on to, there's another question here on consumption versus consumption. So I'll just read it as a whole. So perhaps a consideration of the topic might be where the demand occurs versus production and the impact of transportation costs and the value of sulfur despite the global supply-demand dynamic. And I think absolutely I agree with the premise of this question. So does it matter that it's produced or where it's produced? And I think where it's produced is pretty important. Again, as I mentioned, for North America, you have an industry on the refining side that will be one of the first to be impacted in terms of the global trade dynamic. And as I mentioned, for the Middle East, you have gas production growth that will further increase the dominance that region has in trade flows. So where it's produced is very important. And I think the trend that we essentially see is that markets that are very domestic focused, such as North America, Europe, and very refining focused, will start to need to import a lot more sulfur feedstock, or accept the fact that they'll need to import somebody else's products in terms of fertilizer or other products because they don't have that sulfur raw material themselves. So again, there's lots of different routes to that. As I mentioned, for North America, I don't think sulfur availability is a prime choice for crude feedstock choice and whether you choose sour crudes versus lighter, sweeter crudes. But at the same time, that could impact an internal market balance in some way. But at the same time, on the demand side, there are questions I think that you could potentially see project development being limited because of that potential lack of feedstock availability. I don't think on a global basis we see a structural tightness in supply until at least the 2030s, if not 2040s. But on a regional basis, that is already something that will happen. And again, is not abnormal. Again, the difficulty is you're going to have regions which have been very accustomed to having lots of supply and being able to do whatever they want with that supply and manage the market in that way. That's going to change. And I think North America is true for that. Europe is true in that instance. But essentially, most sulfur consumers in the world are sulfur importers. So it's not a system that doesn't work, but it will be very different for those areas where the alternative currently exists. So thanks for that question as well. I don't know if there are any other questions that anybody has there. I suppose one of the I think I alluded to or tried to discuss in terms of that, the availability and the alternatives, and which of those maybe becomes feasible. And I think sulfur stock drawdown, the kind of prices you need to see significant scale stock drawdown there, is probably consistently prices of $150 to $180 per ton. Probably actually slightly less than that, $140 to $160 per ton FOB would bring that supply into the market. Things like fresh mining, I think that's arguably the upper end of that range, if not a little bit higher. For the kind of changes that you could see or maybe need to see in gas processing or alternative feedstocks, they're in some ways not necessarily linked back to a direct price of sulfur and are maybe more driven by some of the supply risk, or again, maybe similar to the last question, if you're in a situation where you might not have sulfur, would you choose something else first and avoid the need of buying it in the first place? I think they might be more linked to that kind of regional dynamic and availability concerns that could happen in certain areas of the world. So I think there's lots of different potential scenarios. From our perspective, most result in some reduction in sulfur availability, at least in some markets around the world. But that this is not a concern for tomorrow, but is not a concern for never either. So thanks for everyone's time. And that is, I think, all from me, and there weren't any other questions. So Becky, back to you, I think.
Thank you so much, Peter. That was great. And thank you to everyone who joined us today.